So we're about to head into reporting season. So this is where all Australian and New Zealand companies with financial year ends the 30th of June have to report their results. So it's a pretty big, or a busy time of year for us. It's a big news flow month, lots of companies reporting, and the majority of companies in the market are actually reporting their results. So it's very busy and lots to get our head around. So what are we expecting as we head into this reporting season? So if I focus on Australia in particular, we've had a very, very strong earnings upgrade cycle already. If we look at what we're expecting, so earnings per share growth is expected to be around 28% year on year for this financial year. Now that's very strong. That's nearly 30% growth year on year. This has been upgraded from back in February, which is kind of the last reporting season we've had when we last heard from a lot of companies, and that was tracking at about 15% growth. So we've seen an acceleration since February, from February till now, in terms of what that expectation is for those earnings, the earnings outlook. And this is on the back of mainly two sectors in Australia. So it's the banking sector and the resources sector, which make up a large portion of the index, and they've been really strong performers and have had significant earnings upgrades. Now, like I said, it comes down to, when you're looking at share price performance, it comes down to valuation and earnings. So we've got strong earnings growth expectations, but if I look at the other side of the argument, which is the valuations, macro-wise, we are seeing kind of the Fed tapering, and we're seeing higher real yields, which could both be a bit of a headwind. We had the Reserve Bank of Australia come out saying that they expect to increase rates sooner than expected. So that could take the wind out of the sails in terms of valuation. So even though we're getting that earnings uplift, valuations might be a bit compressed. So, but it's good to see that earnings momentum coming through, that will hopefully drive the share price performance. Secondly, is that we do expect more positive earnings surprises in August. So if I again go back to February, we had the greatest number of earnings surprises that we've had in the last 20 years. So in 2 decades, which is very, very strong. And those upgrades came off the back of analysts being a bit more bearish around COVID, and then so since we've come out of COVID from, say, September last year till now, we've had consecutive month-on-month upgrades in earnings in Australia. So we expect that kind of positive momentum to continue as we go into August. And thirdly, I guess, where is the strength coming from? So I mentioned the banks and the resources. So if I focus on the resources names, so they're benefiting as a sector that from very strong commodity prices, so particularly iron ore. Iron ore is now at over $200, and this is on the back of increased infrastructure spend as the global economy opens up. But as well as we've had a lot of supply constraints due to COVID, so particularly from emerging markets. So you have lower supply, higher demand, and that just leads to increased prices. So we're expecting that to continue, and that's benefited the likes of BHP, Rio and Fortescue, which are large resources names in Australia, and they've had significant earnings upgrades. The second sector is banks. So again, the banks' earnings have been upgraded just due to lower impairment charges. Again, it was a case of preparing for the worst, and then the worst not being reality. So the economy has fared much better in Australia than expected. So therefore, the banks continue to do well, and we've seen earnings upgrades of the banks come through as well. On the flip side of that, I guess what sectors are seeing downgrades or disappointments, or not having as higher earnings upgrades would be, firstly, the technology sector. So if we go back to COVID, this time last year, it was mainly the technology companies that were benefiting from people staying at home, people buying more online. That fed into their technology names, so they benefited strongly through that COVID period. Therefore, as we come out of this and we start cycling those strong COVID growth numbers, we could see some unwinding from them in terms of an earnings point of view. Now flipping, I guess, to New Zealand quickly, we're seeing very similar trends in New Zealand and in the New Zealand market in terms of sectors that are having earnings upgrades and sectors that aren't. So we're seeing very similar trends. The issue with New Zealand is that the New Zealand market is much more expensive from a valuation point of view than it versus Australia. So the NZX 50 is trading at over 30 times earnings. This is compared to its long-term average of about 19 times. So it's trading at that premium. And like I said before around what we expect macro-wise and the impact that's going to have on valuations, we could see some pressure in the New Zealand market as those valuations compress. And then on the flip side, if I look at the ASX 200, that index is only trading at about 17 times earnings, which is in line with its long-term average and slightly below the S&P 500. So if I'm looking at Australia and New Zealand, I think going forward, we view the Australian market as much more attractive in terms of share price performance going forward than we do New Zealand at the moment.